Good morning, everybody. And I think that was a spectacular opening keynote speech, so thank you for that. It set up the conversation very nicely for us. Oh, I lost a panelist already.
I need technology.
So yes, I'd like to just make a very quick introduction to the panel. I have Lena next to me here from Clifford, Peter DiFiore from Neuberger Berman, Iain Reynolds from Peak Re, and Hussain Ahmad from Carpenter. And the bios are in the materials, so I'm not going to say anything more about them. But I'm very lucky that we've got people representing a broad spectrum of participants across the ILS market. So since the last Artemis conference, quite a lot has happened in the cat bond market. I think that's been very well covered already, so I don't need to repeat any of those statistics. But we are certainly in an interesting time, a very, very nice trajectory in the cat bond market. Today we're going to focus, given that we're in Singapore, we're going to focus quite heavily on local issues to start off with, and we'll go through various topics relating to Southeast Asia and Asia as a location for issuance of cat bonds. We'll then talk a bit more about what's happened in 23 and 24, and we will then look at a little bit of a forecast into 22 and 25. At the end of a session, we may leave time for questions as well, depending on how quickly we cover the topics we'd like to discuss. So starting off, I thought it would be good to have an update on developments in the ILS market in Singapore and other jurisdictions in this part of the world. Lena, please could you provide a quick overview of the regulatory environment into which sponsors are issuing in this part of the world?
Yep, sure. Thanks, Mark. I've got my technology here, so I can kick off. So I think this is the only time in this panel we're using slides, but I thought it would be quite useful to set the lay of the land if we sort of look at the two major ILS markets in Asia Pacific, being Singapore and Hong Kong, and to set the scene for the rest of the discussion on this panel to run through the regulatory environment in these markets. So kicking off firstly with Singapore, I think you've already heard a bit from Chin Kai at the opening session, but maybe just to dive into it a bit deeper. The MES very clearly sets out that Singapore's aim is to be the leading ILS hub in Asia for Asia, and it's to complement our cat markets here in Singapore, and also Singapore being a reinsurance and insurance center in Asia. So compared to Hong Kong, Singapore was first to the market with the grant scheme, which has played a big role in developing the ILS market here. First launched in 2018 and has been renewed several times now, and we know will be available at least until the end of 2025. So starting with the scope of the scheme, as you heard from Chin Kai, it's not just cat bonds now, but also expanded to instruments like sidecars, collateralized issuances, and there's no restriction in terms of risk, so definitely natural disasters, but also longevity, mortality, operational risks, and hot topic cyber, as we'll hear from later. Now, in terms of funding, it will cover 100% of the issuance costs, capped at 2 million Singapore dollars. Obviously, there are some eligibility criteria, and the requirement is that on the transaction size, it has to be at least 50 million Singapore dollars, and 20% of the issuance cost has to be Singapore-based. And there is a minimum tenor of 3 years. So let's just quickly cast our eye at Hong Kong. It's been around for a shorter period of time. Pilot scheme launched in 2021. Interestingly, also extended now for 2 years from 2023, so similar timeline for Hong Kong. Now the scope. So far, I think we've only seen cat bonds, but I think there's been some sentiment that maybe it can be extended to support collateralized reinsurance and protected cells. Funding, there is a bit of a trunching depending on the maturity period. 100% if it's 3 years or more, 50% if it's less than 3 years maturity. Eligibility includes offshore issuers, but also specifically they've mentioned supranational and multinational organizations. And issuance size is 250 million Hong Kong, with 20% of the issuance cost has to be attributable to revenue of the Hong Kong-based service providers. So hopefully I've painted a quick scene of where we are in Singapore versus Hong Kong. Some similarities, some differences, but same, quite similar in the big picture.
Yeah.
And maybe hand over back to you, Mark.
Well, thank you for covering that topic. Just going on a little bit more about the issuance of transactions within this region. Iain, I wonder if you could please tell us a little bit about your experience in sponsoring a transaction, and also maybe consider or give a view about why maybe Peak Re is the only sponsor of local peril risks so far, and the general issuance environment from a sponsor's perspective.
Sure. Thanks, Mark. And good morning, everyone. I mean, our experience in issuing a cat bond in Hong Kong was wholly positive. I think it was pretty seamless. So we don't have the experience of issuing in Singapore, but as we've seen, the grant schemes are very similar. So it was, it was a good experience. It's a more interesting question as to why we haven't seen more. I think just to qualify that, we are the only Asian domiciled carrier to issue an Asian risk 144A cat bond in an Asian domicile. There have been private deals, and I guess if you extend it to Asia Pacific, you could include the New Zealand bond. But I think as this is Asia ILS, we are the only one. Why is that? Well, I think we have to think about when does collateralized reinsurance make sense compared to rated reinsurance. And it's generally where rated reinsurance is hitting its cost of capital, and that's when ILS becomes competitive, I think. And I think we don't see a supply issue in the wider reinsurance market. We have seen balance sheets bouncing back, and I think there is plenty of competitive rated capacity available on treaty. Now, I work for a rated reinsurer, so I would say that, wouldn't I? But I still think it's true. I think there's possibly less retrocession capacity. I still think we see a supply side issue. Now, again, I'm a retrocession buyer, so maybe I would say that, wouldn't I? But I think the reason why we thought it made sense to issue a cat bond was that we saw the potential for competitive pricing on it. And there is a price consideration there. There are, of course, other considerations. So I think we have to think about where does a cat bond make sense compared to rated reinsurance. How many carriers have their capacity requirement driven by Asia perils? And amongst those, how many of those are reinsurers? I suspect, well, I could be wrong, but my opinion is that's why we're seeing a limited demand. And then to answer your final piece as to what can be done, well, I think as a reinsurer, we would struggle to place a cat bond on an ultimate net loss basis. We haven't seen many of those in any part of the world. Certainly for 144A tradable cat bonds. So we need to use an index, and I think we then have to talk about the credibility of the indices available. We do recognize the efforts of the MAS in introducing indices, or the initiatives on indices in Southeast Asia and the wider region. Personally, I'd like to see someone working on a credible industry loss index in China. I think that would probably be the kickstart that we're looking for. But we would still we still lack data points to benchmark them. But I think if there was a credible industry loss index in China, that would be a good start.
Okay, so broadly, it's the supply and demand question on reinsurance capital compared to the need to go to the ILS market, really, from a sponsorship perspective for local perils, which is interesting. From the point of view of the attractiveness of sponsoring a transaction, by which I mean incentivization to sponsor a transaction, do you think there's anything more that could be done than has been or is being done?
Well, the grant scheme helps, of course it does. I think, to me, the stumbling block is still the lack of an index from our point of view. I mean, I couldn't speak for other players in the market, but that's where I struggle to see why we don't do more at the moment.
Right.
But as I said, our experience of placing a cat bond was pretty seamless. And we did one in Japan where we think we have an index that is credible and will reflect ultimate net loss.
Okay, well, I think we might come to some interesting discussions with Peter with regard to trigger types later on in this conversation. But just before we move on away from the sort of the environment for issuance here, Lena, do you have any further observations about how the market could sort of continue to develop?
Yeah, sure. So two points. I think one, just to build on what Iain mentioned, and I think Chin Kai also mentioned this. I think the key point is data, right? I think that will build towards the index, with the we can fill those data gaps, do proper risk quantification, modeling, pricing. All that's pretty clearly needed. So just to expand a bit on what Chin Kai mentioned this morning in his opening speech, the two sort of big drives going on is obviously that ASEAN Disaster Risk Financing and Insurance Phase 2 program, which involves academics, regulators, industry, but also the Global Asia Insurance Partnership. Again, industry, regulators, and academia looking at the data, going to research, and then hopefully going into sort of indices and other things that will help fill those gaps, risk models, etc. Now, the other thing I wanted to mention is probably more from my area, the legal front, and it's been thrown around a few times, but we haven't seen full proposals, and that is really about whether there are certain structures that can be developed for the market that can help make it even more robust, maybe make it even more efficient, and obviously efficiencies equal hopefully cost savings, and if margins are thin, anything that will help save costs can help. So what am I talking about? I'm talking about not a technology that is totally new, but we see it in other types of products, and that's the segregated cell structures, which currently doesn't exist for use. So for example, maybe just explain. This is where there's a corporate structure, right? And it is consisting of if you imagine like a core entity, and then underneath it various cells. Now it's a single legal entity, and so that entity can enter into obligations, etc. But what happens is each cell will, even though it on its own doesn't have a separate legal entity, it will have its own assets and liabilities that are ring-fenced from the other cells. And so each ILS transaction can be within that cell, but you only have one single entity. So if you think about cost perspective, because it's one entity, you could have cost savings because you only need to set it up once. From a corporate running cost perspective, there may be cost savings. And so, we've seen those structures used in other structured products transactions, and maybe, I think Singapore has thrown that around in terms of maybe expanding our variable capital company structure, which currently exists for the funds industry, and is, gaining a lot of traction. And there was talk about maybe expanding that for more general transactions, and certainly so. I think that will usually involve some sort of legislation that will build in the legal robustness and certainty, and obviously lawyers want to make money, but maybe you'll save on that cost, right? Because you can rely on the legislation. less reliance on some contractual structures, less uncertainty, quicker to market, etc. So, these small wins can have an impact and hopefully enhance the market further.
Yeah, well, thank you, Lena. I think that is a very important development, or could be, because that, as you say, that structure is used in other parts of the world. The segregated part of it is, of course, the absolutely fundamental and critical part.
Absolutely.
So that's the challenge.
Yep.
Thank you. So Peter, just moving to the manager's view of the market, focusing first of all on Asia, what are the characteristics of the Asian market which you find interesting from an investing perspective, and how could you see developments or changes taking place which would make it even more attractive to you?
Thanks, Mark. So I think there's three key benefits that we see. The first, which is probably most obvious, is the potential for portfolio diversification. So, that in itself isn't necessarily attractive enough to enter into the region, but we can talk about sort of the considerations about that. But certainly having opportunities outside the U.S., outside the peak zones, is really interesting. I think the second key benefit is just a further deepening of the broader ILS market. So having new sponsors, more sponsor types, more diversity in sponsor types, more diversity in terms of the types of issuance that are out there, will help create more stability. It'll help enhance liquidity. It'll allow the market to continue to grow beyond the $100 billion to a level much beyond that, and allow us as investors to raise additional capital to participate in the space. So I think that's a really important consideration. And then the third area is for those of us that are focused on ESG positive or sustainable opportunities, the ability to address the disaster gap, obviously a big issue in the Pacific region, and ILS products are really well situated to address a lot of the challenges around disaster risk financing, as we've seen with groups like the World Bank and some of their projects. So those are really the three key considerations that we see, and why we're very interested in supporting the growth of issuance, the increase in activity from sponsors in the region.
Okay, and so looking at the sort of types of triggers that as we just broadly talked about a couple of minutes ago, looking at the types of triggers that could be used in this part of the world. First of all, do you have strong views either way about indemnity or non-indemnity triggers? Can you think about non-indemnity triggers which would be worth developing going forward? I know you've got a very good technical background in the modelling environment as well from previous employments. Also, related to that, do you have any thoughts about just risk analysis generally, the credibility of the modelling of the natural hazard in this part of the world?
Yeah, so I mentioned, and Iain already alluded to the challenges in the region, which the modeling historically has been much less developed. I think as it relates to the physical characteristics of the risks, that's less of an issue now. But when you get into considering indemnity type exposures, the lack of loss history, the questions around data quality and completeness makes that a much more challenging exercise. So in terms of investor interest, I think it's not surprising to start with index and parametric type transactions where those concerns are mitigated. And over time, we'd love to see enhancements in terms of the indices that are available. I agree that they are relatively limited, and while in places like Japan, they're fairly usable. Outside of that, the reliance on parametric makes sense for investors, but less for the issuers. So I think we'd like to see a lot more development on that front. There's some other structural issues that we've seen with some of the issuances in terms of like term aggregate type structures and other factors, but I think it's really just getting more data, more potential deal flow, and starting to try and price all of these various opportunities and having a wide range of opportunities to work with as well. I think one challenge that we've seen with, and this is not just unique to Asia, but non-peak risks, because there are a lot of market participants that seek diversification or have hard constraints in terms of the amount of diversification they must take on, and there's a limited amount of diversifying paper out there, that tends to really put a lot of pressure on the spreads. And so that makes it that much harder, I think, for groups like ourselves that are less constrained in terms of being forced to diversify. It makes it much harder for us to participate in a lot of those issuers. So we would like to see a much more diverse set, a much more deep set of the opportunities with more stable pricing. I think that will really help our ability to raise capital to focus on this segment in particular.
Okay, thank you, Peter. May come back to that later on. Just moving across to your part of the world as the arranger and advisor to potential sponsors in this market, Hussain. Please tell us a little bit about how the world looks like from your perspective when you're talking to people about bringing transactions to market, what they should be thinking about, what the pros and cons of different structures might be, and triggers and so on and so forth.
Thank you. I think there's been interesting array of comments already from the panel. I think one thing that I'm surprised actually nobody's brought up is sort of the difference between the model view and the traditional insurance market view at this point. So particularly if you look at a market like China, what you'll see is some of the cat layers being placed at expected loss, modeled expected loss or below. Obviously that's going to cause differences with sort of the ILS side of things as well. So either over time the models need to improve or the market needs to change. I'm not saying which, but that gap needs to adjust, and that in of itself translates into a number of the considerations that you're talking about. But taking a step back, when you're talking about bringing a sponsor to a new sponsor to the market, there are 3 odd considerations that are valid anywhere in the world, whether it's price, whether it's growth or additional capacity, whether inflation or M&A or et cetera, or just innovation in the structure that's available in ILS market that may not be as readily available elsewhere. I think what we see in APAC, in addition, is a lot more strategic considerations as well, be it some of the Japanese sponsors that want to have additional contact points with the investors in the market, or as it has been the case with Singapore and Hong Kong, sponsors coming up genuinely looking to support the initiative by the regulator and by the country. They want to support the market. They're coming into the market to help build the market and the local infrastructure. Right? So I think that is somewhat, I won't say it's unique at this point. I mean, obviously, the rest of the world has gone through some of that earlier, maybe 20 years earlier, and Asia is doing that now. So we go through a lot of these considerations as to why you're bringing in, and then obviously you have to figure out how to make it marketable. And to that point, in terms of triggers, I'll agree with Peter. Right, it's easier to start with indices. It's easier to start with parametric because that's what investors are going to be able to digest. Sources of data beyond just indices. The reporting for earthquake, as an example, I think investors up to now still prefer to use U.S. Geological Survey, regardless of where the earthquake is in the world, rather than a local authority like China Earthquake Administration, as an example. Because the website's not translated into English, investors are not as familiar with how the reporting happens, et cetera, et cetera. So we have to sort of go through all of these and some more. There's I'd say massive amount of education component in this part of the world as well, and that's education one for investors, bring them through how something is happening here, but also for sponsors. You may have an individual or a group of folks at a company that are willing to move ahead with it, but does the legal team understand all the implications? They have to go through the contracts. Does the finance team understand? I mean, our experience with Peak was fantastic, but as you go out to people who are looking at this from a first-time perspective, there's a very significant education component of just the fundamentals. Why does the SPV not belong to you, and why do you not want it to belong to you? Right? So from that point on to what's placeable limits and some of the other considerations we talked about. I would say one other bit is modeling. The models are not as granular as you see out in the US. The vintage may be a little bit more dated in this part of the world, so obviously that coming up will also help if we can have more up-to-date and more frequent ones. But it's a demand and supply dynamic, right? I think chicken and egg, which comes first. I think we are certainly invested in growth in this part of the world, and we think it will come through.
Yeah. So is it? Do you find that when you're talking to clients of yourselves as a reinsurance broker, that it's a topic which is being driven by them, or is it more being driven by you, just to demonstrate that there's a broader range of services you can provide, there's a choice, or is there actually? Do you feel that there's pressure from the other side to sort of really learn and consider it as an alternative?
We have regular daily queries coming in terms of wanting to learn about the asset class, wanting to learn about the options that they have. So I don't think we have to push it in any way, shape, or form. I think a lot of the queries are coming in to us. So people are interested, generally. I said, if nothing else, and from the perspective of supporting the market or testing it out, knowing what their options are. So those conversations are on almost a daily basis, I would say. Not everything translates to a transaction. We would love for everything to translate into a transaction, but I think it will come through.
Yeah. I suppose just adding a little bit of my own view, in meetings over the last couple of days with potential investors, a very common theme has been, because they're quite educational, some of these conversations, and a very common theme has been, why is this so US-based, this business? Why, in a sense that why isn't it more balanced, and why isn't there more interest in local markets, sort of Asian risk and so on and so forth? I don't know whether Peter, Hussain, you have any more general comments about that. I think we've maybe have said that there's a supply of capital within the reinsurance industry which is adequate. So I guess, how does that change going forward? Is it effectively continued economic development which leads to continued growth in exposures, and maybe that eventually just creates that excess exposure and demand? Is that?
I think that's part of it. I mean, I think the reason that the U.S. is so prominent in the ILS space is the extent of exposure and the focus of rating agencies and regulators on mitigating the accumulation of that exposure with the initial risk takers. And so I think you need both of those things to happen. You need the underlying growth, which I think in the Asia region is expected to be quite significant and leading to that need. But then you also need the regulators and the rating agencies that are proactively pushing towards risk-based solvency capital regimes, which then lead to that risk transfer. And as Iain mentioned, now there's plenty of capital in the traditional market and collateralized market that's willing to take on these risks because they're not the peak. And it really overwhelms the amount of need of issuance. I think those are really the two key drivers: the exposure growth, and then those regulatory constraints that drive the risk transfer.
I'll agree. I think probably one more thing to add is, as we look through RBC or risk-based capital regimes coming through across the region, we have to realize that the region itself is extremely diverse with a number of regulators, and some of them have not necessarily considered ILS as well what this could do, and not that it should matter. It should work as reinsurance, it's collateralized, etc. But sometimes either sponsors or even sometimes regulators could have a bit of a may want to take a bit of a pause to just think through, well, will this work, would that not? Just another minor consideration. And Australia is an interesting example where the capital regime does allow for benefit if you have a reinstatement, which obviously we don't tend to have in this asset class. So I think that little small nuance also, causes. So there's these small factors that are holding things a little bit back, but as I said, the trajectory is generally positive. Yeah.
Okay.
Can I just add something to that? I think if we take China as an example, and I keep coming back to China, forgive me, we have a good understanding of the peril. There's 5,000 years of earthquake history in China, but it's a very young insurance industry, so we have very little understanding of the consequences of the peril, or very few independent benchmarks of it. So we, as a reinsurer taking on UNL risk, we can have our view of it, but to benchmark that view is pretty tricky. And that's where I think we struggle with the idea of using a parametric trigger, because we are assuming a basis risk on the basis of somebody else's point of view. And I think that's where I think that the right direction of travel is in an industry loss index.
Okay, good, thank you. I think that's been quite a nice discussion about some of the more local topics. So let's move a little bit more towards the global ILS market, the global cat bond market. And as was discussed in the initial, as I said, very good opening presentation, we've seen a very interesting period of time. 2023 saw various records being broken. The performance was outstanding, and there was a number of circumstances that all came together to lead to that exceptional performance. And I'm not sure that should be an expected performance going forward, unfortunately. But having said that, we saw there's a constant flux of balance between supply and demand, I suppose, both in terms of the supply and demand of sponsor and primary issuance, but also the supply and demand from an investor perspective. So coming into 2024, there was broad equilibrium, I would say, and there was an expectation, I suppose, that we wouldn't be able to sustain that peak of 2023 pricing going into 2024. And indeed, there was a certain softening trend that emerged into 2024. And then, maybe slightly surprisingly, in the second quarter of 2024, we started to see spreads going up again. So I'm just wondering, Peter, from your perspective, if you could just tell us a little bit about how you saw 2023 and what your expectations were for 2024, and then maybe give a view as to why you think we saw what happened in 2024 Q2 to the spreads, please.
Sure. So 2023, obviously a banner year for the asset class, and hard to follow 20% returns, but obviously driven by the higher cash yields, the higher spreads, the lack of activity, as well as recovery from markdowns from Iain in 2022. So all of those factors working strongly in favor. I don't think that many of us expected the post-Iain peak in spreads widening was sustainable, but I think we were in some ways surprised at how quickly the market trended to tighter spreads, and I think in hindsight, there's been a lot of narratives around kind of how spreads have been moving over the last two and a half quarters, but as Mark mentioned, it's really just supply and demand, and so coming into the beginning of the year, there was a large maturity wall, so a lot of free capital, the cash yields, the spreads, all putting capital back to investors. You had new investors, new inflows of capital, in particular to the cat bond space relative to other segments, because cat bonds have done so well, and the benefits in terms of structures for the investors are quite apparent. And so that really just had a situation where there was a lot of capacity, and the deal flow was delayed. It seemed as if sponsors and desks were potentially testing the market, or they just took their time coming to market. But for whatever reason, there was a dearth of issuance, and so pricing reflected that imbalance, and Q1 pricing came off quite significantly. But then with the significant amount of deal flow, all of that free capital was essentially used up. And in Q2, you saw a situation in which it was the total opposite. There were issuances that were hard to get away or even didn't get away. And so, I think that that highlighted some challenges that I think this market still has, where we really need to work towards having more stability in pricing, more communication and transparency and stability in terms of issuance timing. I think cedents need to be a little bit longer term thinking in terms of their views on where the pricing should be, and more accepting of the fact that now we're really in a higher for longer period, and there may be short-term moves that lead to tighter spreads, but I think the ILS investors have shown great discipline since in the last several years, not only in terms of pricing, but in terms of the structures. The structures have very much improved in the favor of investors, and we've seen many of the issuances that have struggled have been ones that have had less favorable structural elements. So, yeah, it's been a very, I think, a very interesting time in which the market sort of explored different supply and demand regimes. Where we are now, pricing has really recovered, I would say, from that Q1 type of situation, and I think that that sort of puts to rest some of the commentary that the changes we were seeing in the market were driven by concerns about the hurricane season and the forecasts, as well as some model update changes. I think those made for good headlines on Artemis, but really weren't the real drivers. I think it really was more the supply and demand.
Yeah. I do have a follow-up question to that, but I'm just wondering if, Iain, you have any comments about how you've seen the market performing in the last few months?
Yeah, I think it's much harder to benchmark reinsurance rate movement. There's a bigger volume, of course, but there are fewer benchmarks. Cat bonds are much simpler structures. Whether you think models are objective or not, they are at least a benchmark. But I think what we observe is, even if rates aren't moving, we are seeing some softening in terms of terms and conditions, spread of cover and the like, and that's much harder to sort of summarize in a neat graphic of rate movement.
Yeah. My general question, maybe just to anyone who wants to answer it. You touched on this, Peter. It's sort of communication. It's a really important point, and maybe it's more important than people acknowledge. And it comes to do, it's sort of related to the time that it takes to bring a transaction to market in a cat bond form versus a reinsurance contract. Reinsurance contract can be negotiated very, very quickly, and I mean weeks rather than months, whereas a cat bond can take months to structure it and bring it to the market. And it's that time delay which is so important, because it makes it very hard to predict where the market might be 4 months or 5 months down the track. And so the communication between all market participants about the potential volume of primary issuance that's coming down the pipe, and from the investor's perspective, how much inflows there may be coming in, or indeed maturity cash flows coming back in, that everybody sort of needs to somehow be a bit more transparent about, so that we don't find ourselves in stress scenarios in one direction or another. Is there any general comment about that from anyone?
It's not only that, you're locking into a price for a longer period of time as well. So if the market moves against you in the process of issuing, it can be frustrating.
Yeah. Okay, so yeah,
I'll make a comment on that. Yeah, I think there's inefficiencies on both sides. So you talk about the time to come to market and all that goes into issuing a bond, and concerns about locking in pricing that's too expensive for too long. I mean, I guess to that point, I would say that, you know, it's one part of your overall program, so maybe you should be a little more flexible in that. But then on the investor side, there's also a lot of inefficiencies as well. I mean, the cat bond market is one of the more open segments with lower barriers to entry, but it's still challenging to convince new investors or even current investors to allocate into the space. And when they see pricing start to come off, that then feeds back on their hesitancy to see, you know, how the market's gonna play out. So it's you know, we've had several years of these challenges where the timing between the issuance and the capital needed to get that issuance away has been imperfect, and that's created periods on both sides of the transaction that are less optimal. And so, to my point earlier, I think we would love to see much more consistency and a steady state in the market where there's just more consistency in terms of issuance and having more stability in terms of the pricing and more liquidity in terms of the secondary side of the market as well. I think all of that just helps everybody. It'll help sponsors ensure that they know they can tap into the market when they need it. It'll help investors have a better sense of what they're actually getting by coming into the market and participating. And I think that'll translate into further growth in the market.
okay.
I'll just add to that also. You mentioned this, you know, that's true not just from investor point of view, also from sponsors, and I'll just echo that one. As part of the education component that I was talking about earlier, because a lot of times sponsors will ask us, well, what will be the price that will, you know, I will get this away? And when you give them a range and you say, well, and there's market uncertainty and depends on the North Atlantic hurricane season and so on and so forth, you know, it takes a while to just drive that message that, look, there's forces that will drive this. There's a lot more variance here. Whereas for traditional reinsurance, as brokers, we can give you a desk quote and typically within a couple of weeks get you that and you're done. And I agree that the stability would be fantastic, but I think there's a bit of a time gap. There's some time to get to that point.
Right. Speaking of time, the clock of doom is counting down in front of me, and we have just over 10 minutes left. I'm going to do one more question to the panel, and then we'll see if there's anything from the floor, but we can keep talking, obviously, if there aren't any. So my final question is looking forward into 2025. Hussain, you just mentioned the Atlantic season, and that might be part of your answer, but when you're looking forward across the panel, please just give us your quick observations about what you're thinking about when you look into 2024, back end of and into 2025.
So I'll start if that's okay. So look, talking about maturities coming into the market, you know, we expect about 3 billion, 3.1 billion for the second half of this year. Again, assuming no losses obviously impair that, we expect another 9.7 in first half of 2025. So there's a decent schedule of maturities that's coming in. You know, new capital, new investors that are interested, but also on traditional reinsurance side, you know, we estimate about 26 billion of shareholder surplus on reinsurer shareholder surplus expected to be created this year. Some of that will invariably end up in third-party capital strategies as well. So in terms of supply side dynamics, I think there's a fairly robust supply side dynamic coming in. The question is more on sort of the demand. Well, the losses, obviously, that come through in second half this year, but I think that's a given. And that will drive probably more than anything else what the market looks like in 2025. But assuming expected losses, you know, 2024 is set to be a record year, and you know, inflation coming down, demand will temper a little bit, but we do see sponsors you know, gearing up even ahead of 1/1 to test the market in terms of price, in terms of structures that they want. And with any luck, we'll have the trend continuing into 2024 and 2025.
I think it all depends upon this hurricane season. We've had an early start, but of course, there's a lot of scare stories around the forecasts. The forecasts don't always turn into reality. But I think, if a lot of investors suffer losses, then we could see withdrawal. And that will, obviously be an additional push on any hardening we see off the back of a loss season. But it's a weak answer, but it's too early to say. Ask me in 4 months' time.
Peter?
Yeah, I mean, obviously the hurricane season's a huge unknown, and just because it's predicted to be an active season, and we've seen barrel this early, doesn't portend a necessarily adverse insurance loss season. So we'll have to see. And there's certainly a scenario in which there is a loss event, and that actually motivates more inflows from ILS investors into the space who have been sitting on the sidelines, a la what we saw in 2018. So. Very hard to predict where that's going. I think there's obviously still concerns on higher frequency perils like severe convective storm, winter storms when we get to the later half of the year, and all of the other flooding and wildfire type events that could also occur, not to mention earthquakes. Maybe thinking more positively about what we're likely to see moving from this year into next. New cedents, there's been a lot of new cedents issuing cat bonds. That's great to see. I think we'll continue to see that. New risks, new perils like cyber, and so I think that's great. I think we'll continue to see more liquidity in the market, more trading. Obviously, that could be affected by events. There's also all of the discussion around the ESMA's review of the UCITS funds and the eligibility. So that could be a big wild card in the near future as well. So, a lot to watch out for, but a lot to be very optimistic about as well.
Thanks, Peter. And Lena?
Yep. I'll answer your question a bit differently. I like to do some crystal ball gazing, looking around corners. I think some things are certainty, some things question mark. Some I've discussed before. I think as we get into 2025, I guess the question on everybody's minds will be, will the grant schemes be renewed? So we have MES here, people can ask them during the coffee break. Because both Hong Kong and Singapore, there's a sort of, period for the grant scheme. So that's definitely going to be on, given the impact of the grant scheme, that's what people will be thinking about. I talked about potential for, new legislation like the segregated cell. Maybe we might see something on that. That's been discussed for some time, but depends on, I guess, regulators' legislation priorities. We also heard about, use of technology, AI's all the rage, use of blockchain, tokenization. I think there are a lot of pilots going on. Pilots can work. I think the big point, not just in ILS, but just generally would be between pilots and commercialization. How do we, to make it successful, it needs to get to commercialization. So that's the key point, I think, generally in that market where people are at. I think the technology and the human sort of drive is allowing the pilots. Its question is, how big is it, and where are the problem points? Is it we're going for fractionalization or just some sort of settlement solution? So I think that's the big issue. Something I'll just want to add on the education point. I think as we get more data and there's a real proposition for Asian risks, I think the other point is regulator understanding. And we see that in other sort of complex structures where, you're trying to use these structures to deal with regulatory capital. So regulators need to be in this region. And as you point out, Hussain, there are so many different regulators at different points. They need to understand how this works and how that will impact their insurers that they're watching. So, I'm not really answering your question, but it's more crystal ball gazing as to, I think, how things will shape and drive this market.
Thank you. That's all good broad thinking. Thank you very much. So with that, we do have 5 minutes left on the clock for a chance for you to ask questions. So I think there may be a microphone as well for people to be able to hear the question. So here it comes. Could we have the microphone down here at the front, please? Down
front.
here. Stick your arm up. There you go. Thank you. That is on.
Thank you. So this question for the panel, do the panel agree that Asia doesn't require 2 ILS hubs? And if so, which hub will win out and why?
That's a challenging.
Okay, I'll answer. I disagree. And I think I'm not sure that less competition is ever a good thing.
I'll add that I think it's do we need is a different question, but would Singapore and Hong Kong are they in a position to service different clients, different sponsors in different ways? The answer is yes. Will there be enough volume, like Bermuda type volumes through any of these? I think that's a more difficult question to answer, and probably not in the near term. It doesn't mean that it can't coexist.
Yeah. I mean, I don't. Any further comments? I don't.
I'm directly in front of MES. So.
Yeah. I mean, my view is the more the merrier. I don't think there needs to be a restriction on the number of jurisdictions that can.
It's like the argument is always between Hong Kong, Singapore, but I think there will always be space.
Exactly, I think.
Yeah, and it's maybe different priorities. I think from my slide that I showed just now, in Hong Kong, they very clearly talked about the access to the China market. So there's been a very much focus. MES has clearly said it's Asia, for Asia. Yeah. So, slightly different focus, slightly different players, but I think there is space.
Thank you.
So just to add to that, obviously we're not regulated by the MAS, but we are regulated by the Hong Kong Insurance Authority, and it's a lot easier to get recognition for your cat bond from the same authority that's producing the scheme whereby you can issue it.
Okay, thank you. Any more? There's a question just here.
Thanks. Hi guys. My name is Piyush. I represent Shema General Insurance. We are a tech-based, agriculture-focused direct insurance company from India. We do everything. Like we have 3 million customers roughly, and we're trying to tap into the ILS space to provide capacity to those. So my question would be, do you see any appetite, especially if it is a capped quota share sort of a treaty we are looking for, or a transaction? Do you see any appetite for that, and any advice you can give us to tap into this market?
Sorry, just to be clear, what's the underlying risk that you're thinking about?
So the underlying risk would be catastrophe, but on the agriculture side.
Right, okay. May I go to you, Peter, for that?
I'm going to say, let the investors answer that.
So, it comes down to, having the opportunity to review the transaction and determining whether there's an ability to comfortably quantify the risk, as we talked about, the challenges in the Asia region, and then ultimately the potential pricing. So, it's all about communication, and we're open to looking at anything and giving feedback on what we would need to see in terms of pricing and structural components, and then you would have to decide whether that makes sense from your side. And I don't know in your region whether there's regulatory constraints as well, but that would be more on your side. So to the first question, as investors, we're less sensitive to where these opportunities are being sourced and structured.
Okay, thank you. Does that answer your question? Okay, thank you. We've got time for... Oh, no, we haven't. We've gone red, but we just maybe one more. There's an arm over there. Could we have just one last question? Thank you.
Thank you. Question to the panel about the data requirements. I'm from China Continental Insurance Brokers. We are the leading reinsurance broker from China, and we have team members former from Iain Winfield, from Munich Re, AAR, and we have placed over 10 parametric programs from China in the last 5 months. but it's to the traditional reinsurance market. And we, as local reinsurance broker, we got access to very detailed local data, CAT data from China, but we have never placed any program to the ILS market. So probably question to Iain and Hussain. If we are trying to do model and place risk to the ILS market, what's the data required? Because right now we have access to like data to the traditional data source, like the Earthquake Bureau, the Meteorology Office, but we also get access to data like satellites, drones, IoT devices. So there are lots of data from China. It's really question is, what data is required for the market? Thank you.
Right. A good long question and very little time to answer it. So please do your best, gentlemen.
Okay, I can be brief. So we have assumed risk on a parametric basis, but that means that basis risk is not with us because we have a view of the risk. So we're happy to do that.
Yeah, on the parametric side, I mean, you don't have to provide any data. You just have to decide sort of you would have to decide internally how you manage your basis risk by setting the appropriate parameters, and then we would just assess the natural events probability. If it's more based on some sort of satellite-derived damage or even modeled loss, then that would be a little bit more involved. But that's the benefit of a parametric or index type of approach is that we don't require data from the counterparties, from the cedents, because of the way the structures work.
I just add, so the data that you need is to help you design the structure that's going to work for the clients, right? From getting into the market perspective, just need the loss information to be verifiable and trustworthy. The sources, where is the loss coming from, who's reporting it, and does that make sense for investors? Can they get their heads around that? But in terms of the underlying data, the depth and granularity of it, that you need just to design the structure in the first place that works for your clients.
Okay, I think mindful of time, I would just like to thank very much Lena, Peter, Iain and Hussain for taking part in this panel, and thank you for your questions and attention.